Okay, let's unpack this. Imagine you've just received uh, a mysterious form in the mail, perhaps a Schedule K-1.
Right.
For many people, it probably looks like just a jumble of letters and numbers, just another piece of bewildering tax paperwork.
Mm-hmm. Something to hand straight to the accountant, maybe?
Exactly, or, shove it in a drawer. But for the discerning eye, the curious mind, it's actually far more than that. It's kind of like a treasure map.
That's a great way to put it. A treasure map specifically to potential tax benefits and savings right here in the U.S. tax system.
Yeah.
Absolutely. And these forms, particularly the Schedule K-1 from partnerships that's Form 1065 and S corporations, Form 1120S, they're not just about reporting your share of income. Not at all.
There's more beneath the surface.
Way more. They are absolutely packed with crucial information that, when you properly understand it, when you leverage it, can reveal significant opportunities for you, the individual investor or business owner.
Opportunities to do what, exactly?
To optimize your tax position, to save money. I mean, these forms are designed specifically to communicate your precise share of the entity's financial activity directly to you and, well, by extension, to the IRS.
So ignoring the details is risky.
It's truly leaving money on the table. You're missing out on understanding potential benefits baked right into the form.
Exactly. So our mission in this deep dive is to guide you through these often overlooked, yet, like you said, profoundly powerful documents. We're going to extract the most important nuggets of knowledge, focusing specifically on where these forms signal potential tax advantages within the U.S. tax code.
And how you can understand and actually use that information.
Precisely. Think of it as maybe a shortcut to being truly well-informed about your flow-through investments. We'll uncover some surprising facts, some practical insights that can genuinely impact your tax situation.
Potentially saving you a substantial amount of money, yeah.
We're going to break down the technical jargon, translate the legalese into plain English.
Make it understandable.
And show you exactly what to look for to maximize your financial insights. We want to turn this seemingly opaque government form into a clear guide for tax optimization. Let's unroll this map. Okay, so first things first, let's begin our journey by understanding the very foundation of this treasure map. What is a K-1? Fundamentally.
Good starting point.
Because it's definitely different from your standard W-2, right? Which just reports wages from an employer.
Right, or a 1099, which might report, investment income like interest or dividends from a bank or brokerage. Simple stuff, usually.
Yeah. A K-1, on the other hand, it reports your share of a business's or an investment's income, deductions, credits, all sorts of other items.
As if you directly earned or incurred them yourself.
Ah, okay, so it's like a direct pipeline.
Exactly. It's the conduit through which the financial life of the entity is reported directly to its owners.
Got it.
And that leads us to why K-1s are so fundamental. They're tied to what we call flow-through or pass-through entities.
So that flow-through part is key, right? That's where the benefit starts.
Precisely. This is where the core tax benefit begins, and honestly, it's a massive one. The business itself, whether it's a partnership or an S corporation, generally doesn't pay income tax at the corporate level.
Okay, wait. The business itself doesn't pay tax.
Generally, no federal income tax. Instead, it's profits and losses, deductions, credits, pretty much everything flows directly through to the owners.
So to me, the partner or shareholder.
That's right. You then report these items on your personal tax return, your Form 1040.
Ah, I see. So it avoids that. What's it called? Double taxation.
Exactly. It inherently avoids the dreaded double taxation scenario that traditional C corporations face.
Where the corporation pays tax on its profits.
And then shareholders pay tax again on dividends they receive from those already taxed profits.
Ouch.
Yeah. For flow-through entities, the income is taxed only once at the individual owner's tax rate. This single layer of taxation is a significant inherent advantage.
Makes sense why these are popular for certain businesses then?
Hugely attractive for small businesses, real estate ventures, joint investments here in the U.S., absolutely.
Okay, so on our treasure map, we're dealing with like two main types of X's marking the spot, so to speak.
Good analogy.
We have Schedule K-1, Form 1065 for partnerships.
That's right.
And Schedule K-1, Form 1120S for S corporations.
Correct.
Now, you said they both share that fundamental flow-through characteristic income and deductions passed directly to me.
Yes, that's the core similarity.
But there are crucial differences in their underlying structures, right? And how things are reported.
Absolutely. And these distinctions, subtle as they might sometimes appear, can profoundly impact your specific tax benefits and how you calculate your taxable income or
So
loss.
it's really vital to know which map you're holding.
It really is. While both are flow-through, their internal structures and how certain items get reported vary, this directly impacts the nuances of your tax situation.
Can you give an example of a key difference?
Sure. Take the partnership K-1, the Form 1065. It provides extremely detailed information on partners' share of liabilities in Box K-1.
Liabilities, meaning debt.
Yes, the partnership's debt. This is a truly unique and honestly profoundly impactful feature for partnerships because these liabilities can directly increase your tax basis.
My personal tax basis. How does the partnership's debt do that?
It's a quirk of partnership tax law. It basically allows the partnership's debt to, in effect, fill up your personal capacity to take deductions or receive tax-free withdrawals.
Wow.
This level of detail regarding liabilities and its direct impact on basis isn't present in quite the same way on an S Corporation K-1.
So what does the S Corp K-1 show related to basis?
Well, the S Corporation K-1, the Form 1120S, it lists loans from shareholders in Box I.
Ah, so loans I make to the S Corp.
Exactly. And also items affecting shareholder basis in Box 16. These serve similar but distinct roles for calculating your basis.
How so?
Well, those direct shareholder loans do increase your S-Corp basis, which is fantastic for deducting losses, by the way. But general corporate debt, like a bank loan to the S-Corp itself, usually does not increase your basis. That's a huge difference from partnerships.
Got it. So partnership debt can help my basis, but S Corp debt generally doesn't, unless I loan the money myself.
You've got it. Understanding these precise differences is absolutely key to identifying the specific tax advantages relevant to your particular investment structure.
And getting it wrong could be costly.
Oh, definitely. Misinterpreting these nuances can lead to missed opportunities for deductions or, even worse, unintended tax liabilities down the road. It's really about knowing the specific rules of the game for each entity type.
So bottom line for you, the listener, trying to decode this map, understanding which K-1 you have, partnership, 1065 or S Corp 1120S, is the absolute first step.
The critical first step.
Each form is tailored to its specific legal structure, and recognizing those distinctions is where the real work of maximizing your benefits begins. It's the first clue on your treasure map. Okay, we've got the foundations down. Now let's dive into something that can truly make a significant difference in your actual tax bill. The character of the income reported.
Ah, yes, a very important concept.
Because, as you probably know, not all income is taxed equally under the U.S. tax code, right?
Not even close.
And this is where K-1s start to get, well, profoundly interesting for your bottom line. It's where different paths on the map lead to different amounts of treasure, you could say.
Indeed. The IRS classifies income in all sorts of different ways, and certain classifications come with significantly preferential tax rates, lower rates.
Which means more money stays in your pocket.
Exactly. Your K-1 will meticulously categorize these various types of income and gain, allowing you, or your tax preparer, to apply the most favorable tax treatment available. This granular detail is just a goldmine for tax planning. Because understanding these distinctions means you can legitimately pay less tax on certain types of earnings simply by reporting them correctly based on the K-1's classifications. It's a direct benefit of the flow-through structure itself.
Okay, let's break it down. Where do we start? Box 1.
Good place. Box 1 on both forms shows ordinary business income, loss. This is really the bread and butter of the business, the profit or loss generated from its primary operation.
And this is usually taxed at my regular income rate.
Typically, yes, taxed at ordinary income rates. But the real strategic nugget here often comes into play if it's a loss.
Ah, the loss scenario again.
Right. A loss in Box 1 can often directly offset other ordinary income you might have.
Like my salary from a job.
Exactly. Your wages, maybe income from another active business you run, even interest income in some cases. So if the partnership or S-Corp had a challenging year and reported a loss in Box 1,
that loss could reduce my total taxable income.
It could directly reduce your overall taxable income from other sources, yeah, which is a powerful immediate benefit. Puts cash back in your pocket, effectively.
So for the listener, a loss isn't always just bad news in the tax world, right? It can actually be a useful temporary tax shield.
Precisely. It's not just a reflection of poor performance for the business, maybe, but a potential immediate tax advantage for you.
Provided I have enough basis, and it's not limited by other rules we'll get to later.
Exactly. Those are key qualifiers we'll definitely cover. But yes, it allows you to potentially defer tax until the business turns profitable or you sell your interest. It smooths out your tax burden.
Okay, what's next? Boxes 2 and 3. rental income.
Right. Box 2 is net rental real estate income, loss. And box 3 is other net rental income, loss. Rental income, especially from real estate, often comes with significant deductions.
Like what?
Well, the most prominent one is usually depreciation. Depreciation is a non-cash expense.
Meaning it reduces taxable income, but I don't actually spend that cash.
Exactly. It represents the theoretical wear and tear on the property, so it reduces your taxable income without affecting the actual cash flow you receive from the property.
This sounds like a great deal for real estate investors.
It's a substantial ongoing benefit. It effectively allows you to defer tax on a portion of your rental income year after year.
But there's a catch, I bet. You mentioned passive activity limitations earlier.
Ah, good memory. Yes. Listeners should be acutely aware of the potential mention of passive activity purposes. That's box 23 on the 1065 K-1 or box 19 on the 1120S K-1.
And what did that flag mean?
It flags potential limitations on deducting these rental losses. If your rental activity is considered passive, which generally means you don't materially participate in its operations according to specific IRS tests.
Like, I just collect rent, but don't manage the property day to day.
Kind of like that, yes. If it's passive, your losses might only be deductible against other passive income you might have, not against your salary, for instance.
Ooh, okay. That's a common pitfall then.
It's a very common pitfall. So understanding your participation level, whether you're active or passive, is absolutely key for rental losses.
Got it. Now, for partnership investors specifically, Box 4 mentions guaranteed payments. What are those about?
Right. Box 4A is guaranteed payments for services, 4B is guaranteed payments for capital, and 4C is the total. These are essentially payments made by the partnership to a partner.
Like a salary.
Sort of like a salary for services rendered or
Mm.
like an interest payment for the use of their capital. The key is they're paid regardless of whether the partnership actually has enough income that year.
Okay, so what's the benefit here? Who benefits?
Well, from the partnership's perspective, these guaranteed payments are generally deductible expenses when calculating its ordinary business income, box 1,
Ah, so the partnership deducts it.
which means it reduces the amount of ordinary business income that then flows through to all the other partners, or potentially even the receiving partner's share of ordinary income.
Okay, so it lowers the overall taxable pie for the group.
It can, yes. From the receiving partner's perspective, it's definitely taxable income, usually self-employment income if it's for services. But for the other partners, it can mean a reduction in their share of taxable profit.
Interesting. So it clarifies compensation, but also allows a deduction at the partnership level?
Precisely. It can be an advantageous way to structure things for tax planning within the partnership.
All right, here's where it truly gets exciting for personal tax rates, I think. The place where you can see some of the most significant savings, the holy grail for many investors, capital gains.
Absolutely. This is often where the biggest direct tax rate benefits lie. The K-1 forms are incredibly precise in delineating various types of capital gains.
And why is that precision so important?
Because, as we said, different types are often taxed at significantly lower rates than ordinary income. This distinction is crucial for maximizing your after-tax returns.
Making sure profits aren't unnecessarily eaten away by taxes.
That's the goal. You want to keep more of what your investment earns.
Okay, let's break these down. Where do we see them?
All right. First up, qualified dividends. They're reported in Box 6B on the Partnership Form 1065 and Box 5B on the S-Corp Form 1120S.
And these are different from ordinary dividends.
Yes. While ordinary dividends in Box 6A or 5A are typically taxed at your regular ordinary income rates, qualified dividends generally qualify for the lower long-term capital gains tax rates.
How much lower are we talking?
Significantly lower for many people, 0%, 15%, or 20% for most taxpayers, depending on their overall taxable income. Compared to ordinary rates that can go much higher, that's a direct substantial tax saving, a clear win when you see them on your K-1.
Nice. What about other capital gains?
Okay, then you have short-term capital gain loss.
Okay.
That's Box 8 on the 1065, Box 7 on the 1120S.
Short-term means held a year or less.
Correct. These gains are generally taxed at ordinary income rates, so no special lower rate here.
So where's the benefit?
The benefit comes into play if it's a loss. A short-term capital loss can offset other capital gains, short-term or long-term, and, importantly, you can use up to $3,000 of net capital loss per year to offset ordinary income.
Ah, so a loss here can still provide a valuable deduction.
Definitely. It can directly reduce your taxable income.
Okay, but the real star is long-term capital gain, right?
That's usually the one people are happiest to see. Net long-term capital gain loss, is in Box 9 on the 1065, Box 8A on the 1120S.
And this is for assets held more than a year.
Yes. These gains typically enjoy those significantly lower tax rates. We mentioned the 0%, 15%, or 20% rates. This provides a major benefit for investors.
This is often the most sought-after type of income on a K-1, I imagine.
For good reason. It allows you to grow your wealth much more efficiently, keeping more of what you earn after taxes.
Are there other types of long-term gains listed?
Yes, a couple of special categories. Collectibles, 28%.
Huh.
Gain loss. Box 9B on 1065, Box 8B on 1120S.
Collectibles like art or coins.
Exactly. Art, antiques, coins, precious metals, things like that. While it's still a long-term gain if held over a year, it's important to differentiate because it has a higher maximum tax rate of 28%.
Still better than top ordinary rates potentially, but not as low as the 15% or 20%.
Correct. It's a specific category for a specific type of asset, important to track separately.
Okay, and the last one in this section.
Unrecaptured Section 1250 gain. That's Box 9C on 1065, Box 8C on 1120S. This applies specifically to depreciation recapture on real property.
Depreciation recapture. Sounds complicated. Like the IRS taking back a benefit.
Sort of. Think of it this way. If you've depreciated a building for tax purposes over the years, taking deductions for its wear and tear, reducing your taxable income,
Right.
when you sell that building for a gain, the IRS wants to recapture some of that previous tax benefit attributable to the depreciation you claimed.
So I have to pay tax on it.
You do, but the good news is, even this recaptured portion often gets a preferential tax rate. It's capped at 25%.
Again, better than my ordinary income rate if I'm in a higher bracket.
Often, yes. It's a specific category designed to reclaim some of the tax benefit from depreciation upon sale, but it still usually offers a preferential rate compared to ordinary income.
Okay, that makes sense. Now, moving on slightly, we have Section 1231 gain loss in Box 10 on Form 1065 and Box 9 on Form 1120-S. This one sounds complex, definitely some tax jargon there.
It does sound a bit intimidating, yeah.
But I've heard it referred to as the best of both worlds for tax purposes. Is that accurate? That sounds almost too good to be true.
Well, it often lives up to that reputation. Section 1231 gains and losses arise from the sale or exchange of certain business property, think machinery, equipment, buildings that has been held for more than a year.
Okay, business assets held long-term.
Right. And the beauty of Section 1231 is its asymmetrical tax treatment. This is where the best of both worlds comes in.
How does it work?
If the net result of all your Section 1231 transactions for the year is a gain, that net gain is treated as a long-term capital gain.
Meaning it benefits from those lower capital gains. Tax rates 0%, 15%, 20%.
Precisely, which is immensely valuable. But, and this is the kicker, if there's a net Section 1231 loss for the year,
What happens then?
it's treated as an ordinary loss.
Ordinary loss.
Yeah.
Meaning it can offset any type of income.
Exactly, including your wages, your other active business income, portfolio income, making it fully deductible against ordinary income, which is incredibly powerful, especially if you're in a high tax bracket.
Wow. So lower capital gains rates for gains, but fully deductible ordinary losses for losses.
You got it. It truly is one of the most favorable tax treatments in the entire code for business assets. It allows for incredibly strategic timing of asset disposals, potentially.
That's a fantastic benefit to understand. Okay, this next one sounds like the ultimate benefit income you might not pay tax on at all. We're looking at Box 18 on the Partnership K-1, tax-exempt income and non-deductible expenses.
Yeah, tax-exempt income.
Yeah,
It sounds good, doesn't it?
It sounds great. How does this work?
Well, if your partnership happens to invest in things like, say, municipal bonds.
Bonds issued by state or local governments.
Correct. The income generated from those investments can be tax-exempt at the federal level. And sometimes, depending on the specific bonds issuer and where you live, it might be exempt from state and local taxes too.
So the partnership gets this income, passes it through to me via the K-1.
And it's reported here in Box 18. It represents pure, untaxed income flow directly to you. You get the cash, but Uncle Sam doesn't take a bite at the federal level.
Amazing. Is there more to it?
Yes. And here's the subtle yet profoundly powerful added benefit, something a lot of people miss. This tax-exempt income also increases your tax basis in the partnership.
Increases my basis. even though I didn't pay tax on the income.
Exactly. Think of your basis, as we'll discuss more later, like a financial reservoir. It's the pool of money representing your investment that you can draw from tax-free when you receive tax-exempt income reported on the K-1.
It's like that tax-free income pours into my reservoir, making it bigger.
Perfect analogy. And a higher basis allows you to receive more tax-free distributions from the partnership in the future.
So it amplifies the benefit.
It's like a double win. Tax-free income now and increased capacity for tax-free cash distributions later. This is a massive boon for cash flow planning, especially for long-term investors holding these types of assets within a partnership.
Okay, so far we've really focused on how the character of the income reported on your K-1 can lead to lower tax rates, different types of income, different tax treatments.
Right, focusing on the rate side of the equation.
But K-1s also report direct ways to reduce your taxable income itself, or even your actual final tax liability.
Absolutely. This is where we look for the true direct offsets. Think of them as specific deductions or credits flowing through.
It's like finding extra routes on the treasure map that lead straight to the gold.
Good way to think about it, and it's crucial here to understand the difference between deductions and credits.
Right. Can you quickly recap that?
Sure. Deductions reduce the amount of your income that is subject to tax. So the actual tax savings you get from a deduction depends on your marginal tax bracket. If you're in the 24% bracket, a $1,000 deduction saves you $240.
Okay. And credits.
Credits, on the other hand, are dollar-for-dollar reductions of the tax itself, your actual tax bill.
So a $1,000 credit saves you?
$1,000, period.
Wow. Much more powerful.
Generally, yes. Credits are often referred to as tax gold for that reason. You want to find as many of those as possible.
Okay, let's look through some of this gold. What's a key deduction we might find on a K-1?
A prime example of a powerful deduction is the Section 179 deduction. It's reported in Box 12 on the Partnership Form 1065 and Box 11 on the S-Corp Form 1120S.
Section 179. This is a big one that often catches people's attention, especially small business owners. What exactly is it, and how does it help me as an investor receiving a K-1?
Right, it's very popular. Section 179 allows businesses to immediately deduct the full purchase price of certain qualifying equipment and/or software that they buy or finance during the tax year.
Instead of depreciating it slowly over many years.
Exactly. It's a significant acceleration of deductions. Rather than spreading the cost over, say, 5 or 7 years, they can potentially write off the entire amount in the year they put the asset into service.
And how does that benefit me, the K-1 recipient?
Your share of this immediate expensing benefit flows through directly to your personal tax return via the K-1. This results in a potentially substantial reduction in your current year's taxable income from that specific business.
So if the business buys a new machine for, say, $100,000 and I own 50%,
You might be allocated a $50,000 Section 179 deduction on your K-1, subject to various limits, of course. But instead of deducting that over several years, you could potentially deduct a large chunk, maybe all $50,000 right away.
wow, that directly lowers my personal income from the business.
It does. It's a direct incentive from Congress for businesses to invest in growth and efficiency, and that benefit is passed directly through to you, the owners. It provides a tangible and immediate tax saving in the present.
That sounds like a powerful tool for managing the current year's tax bill, like finding a major shortcut on our map.
Precisely. It's an immediate expensing benefit, a fantastic tool for managing current year taxable income, and offers significant cash flow advantages. One of the most popular benefits for small and medium-sized businesses.
Okay, what else? Are there other deductions listed?
Yes, often you'll see other deductions. These are reported in Box 13 on the 1065 K-1 and Box 12 on the 1120 SK-1.
A catch-all category.
Pretty much. It acts as a catch-all for various other deductible expenses that flow through from the entity. Now, the specifics would be detailed in an attached statement.
Which we should always check.
Always, always, always check those attached statements for the details. The crucial point, though, is that these deductions, whatever they are, reduce your overall taxable income from the investment.
What kind of things might be in there?
Oh, it could be anything from certain unreimbursed partner expenses, maybe depletion deductions if it's a natural resource partnership, perhaps certain retirement plan contributions made by the entity on your behalf. It really depends on the business.
But every dollar reported there means a dollar less of income I pay tax on.
Correct. So these are very important to capture accurately.
All right, now on to the real tax gold credits. We already established they're better than deductions. How do K-1s deliver these?
Credits are indeed pure gold, or maybe more accurately, pure cash savings. Remember, A $1,000 credit saves you the full $1,000 off your tax bill, regardless of your tax bracket.
That direct dollar-for-dollar reduction.
Exactly. Your K-1 reports your share of various credits generated by the entity. You'll typically find the main categories listed in Box 15 on Form 1065 and Box 13 on Form 1120-S.
What are some examples of credits we might see flowing through?
There are quite a few possibilities depending on the business. You might see the low-income housing credit. That's a significant incentive for affordable housing investors.
Okay.
Or the credit for employers' Social Security and Medicare taxes paid on certain employee tips. Maybe the credit for biodiesel and renewable diesel fuels if the business is involved in that area. There are research credits, energy credits, lots of possibilities.
And the details would be where? In those attached statements again.
Often, yes. Or sometimes broken out further down in the other information sections, like Box 20 on the 1065 or Box 17 on the 1120S. Each dollar of credit reported is a direct reduction of your final tax bill.
Making them incredibly powerful tools for minimizing the actual tax you owe. Truly hidden gold coins on the tax map.
Couldn't have said it better myself. They are highly valuable.
Is there anything else in this section related to direct tax reduction? Maybe for international stuff?
Yes, actually. For partnerships with international operations, Box 21 on the partnership K-1, Form 1065, is vital. This box reports foreign taxes paid or accrued.
So taxes the partnership pay to other countries?
Exactly. If your partnership conducts business or invests overseas, it might pay income taxes to those foreign governments on the profits earned there.
And why is that important for my U.S. tax return?
Because you, as the partner, can generally claim a foreign tax credit on your individual U.S. return, Form 1040, using Form 1116 typically, for your share of those foreign taxes paid.
Ah, so I get a credit on my U.S. taxes for taxes already paid elsewhere.
Correct. This mechanism is critical because it prevents double taxation, ensuring you're not paying tax on the same income to both the U.S. and a foreign government.
That makes sense. It's about fairness.
It is. It's a key mechanism for international investors or businesses operating globally to maximize their after-tax returns, bringing more money home without being taxed twice on it.
All right, this next section feels perhaps the most fundamental for understanding how K-1s really impact your ability to use losses and, maybe just as importantly, receive money without immediate tax consequences.
Yes, this is the bedrock.
We're talking about basis. Now, this is a concept that can often be confusing for people, myself included sometimes, but you're saying it's absolutely central to unlocking the full tax benefits of these investments.
Basis is truly the cornerstone. It dictates so much. Think of it as your investment cost or your financial stake in the entity, but it's not static. It's dynamically adjusted over time.
How does it get adjusted?
Well, it starts with your initial capital contribution, maybe the property you put in. Then it's increased by your share of the entity's income, including that tax-exempt income we discussed,
Okay.
and any additional contributions you make. And then it's decreased by your share of the entity's losses, and crucially, by any distributions or withdrawals you take out.
So it's constantly changing based on what happens in the business and my interactions with it.
Exactly. And knowing and meticulously tracking your basis is absolutely crucial. Why? Because it dictates the tax consequences of nearly every transaction involving your investment.
Like what?
Like determining how much loss you can actually deduct in a given year, and determining how much cash you can withdraw from your investment without incurring additional tax.
So if I don't have enough basis, bad things can happen tax-wise.
Potentially, yes. Without sufficient basis, even legitimate business losses flowing through on your K-1 can be suspended. That means you can't use them to offset your other income in the current year.
Yeah.
They get stuck, waiting for more basis.
And distributions.
And cash distributions that you might assume are just a tax-free return of your investment could suddenly become taxable income, usually as a capital gain, if they exceed your basis.
Ouch. Unexpected tax bills are the worst.
They really are. So tracking basis is like knowing the capacity of your financial reservoir, as you put it earlier. If you try to pull out too much loss or too much cash, you hit taxable water.
Okay, crucial stuff. Let's look at how K-1s help us here. Starting with partnerships again, Form 1065. You mentioned Box K-1, partner share of liabilities, was unique.
Yes, this is one of the most significant and unique aspects of partnership taxation related to basis. Box K-1 meticulously breaks down your share of the partnership's liabilities into 3 categories: non-recourse, qualified non-recourse financing, and recourse.
And we established earlier, counterintuitively, that these partnership debts can increase my personal tax basis. Why is that such a big deal?
It's a huge deal because it directly impacts your capacity to deduct losses and receive tax-free distributions. It's like your tax piggy bank for losses and withdrawals gets bigger, even though it's the partnership's debt, not necessarily money you personally put in or are fully liable for in all cases.
Can you quickly define those debt types again?
Sure. Non-recourse liabilities. These are debts typically secured by partnership property where no individual partner is personally liable beyond the property itself. If the partnership defaults, the lender can generally only go after the pledged property. Think of a typical commercial mortgage on an investment property where the partners haven't personally guaranteed the loan. Qualified non-recourse financing. This is a specific type of non-recourse debt, usually related to real estate, often from a commercial lender, that can have slightly more favorable treatment under certain complex tax rules, like the at-risk rules we'll touch on, recourse liabilities. These are debts for which at least one partner bears the economic risk of loss. Meaning, if the partnership can't pay, a partner or partners could be personally on the hook to pay it back from their own assets.
Okay. And the key tax benefit of having these listed in Box K-1 is?
The key benefit is that by increasing your tax basis, your share of these liabilities allows you to deduct a larger amount of partnership losses than you otherwise could. Remember, you can only deduct losses up to your basis.
So if I have a $20,000 loss flowing through, but only $5,000 of basis for my capital, if I also have $15,000 in basis for my share of liabilities.
You could potentially deduct the full $20,000 loss in the current year, assuming other limitations don't apply. Without that liability basis, $15,000 of your loss would be suspended.
Wow. So liabilities help create that crucial capacity to utilize losses right away.
Exactly. It provides an immediate tax benefit by reducing your current taxable income. This is a very distinct advantage partnerships often have over S corporations, especially for leveraged businesses like real estate. It's a strategic difference when choosing how to structure a venture.
Okay, what else on the partnership K-1 helps with basis? Box L.
Yes, Box L, the partner's capital account analysis, is another critical element closely tied to basis. Think of this box as providing a mini balance sheet of your equity stake in the partnership. It helps you track the movements in one component of your basis.
What does it show?
It typically shows your beginning capital account for the year, your starting point, any capital contributed during the year. This directly increases your capital account and, importantly, your basis, like adding more cash to your tax piggy bank, your share of the current year net income loss. Profits increase your capital basis, losses decrease it, potentially other decrease. Always check the attached explanation for these items. And very importantly, withdrawals and distributions, which are also reported separately in Box 19 on the 1065, these decrease your capital and basis.
So the ending capital account is like a snapshot of my investment value on the partnership's books at year end.
Essentially, yes, according to whatever accounting method the partnership uses for capital accounts, tax bases, JAP 704B, etc., which can differ. But understanding these movements is essential for tracking your tax basis, which might be different but uses these components. It's a running tally, and critical for knowing the tax impact of distributions and losses.
Got it. There are also boxes M and N about built-in gain or loss and Section 704C, gain or loss. Those sound pretty technical.
They are a bit more nuanced, yes. Box M asks, did the partner contribute property with a built-in gain loss? And Box N reports the partner's share of net unrecognized Section 704C gain or loss.
What's the gist here?
The gist is, if you contributed property to the partnership and its fair market value was different from its tax basis at the time you contributed it, say you put in land worth $100K that you only paid $20K for.
That's an $80K built-in gain.
Exactly. These boxes flag that situation. Special tax rules, specifically under Section 704C, apply to ensure that pre-contribution gain, or loss, is allocated back to you, the contributing partner, when the partnership eventually sells that property or depreciates it.
Ah, so it prevents that gain from being unfairly spread to other partners who didn't benefit from the initial low cost.
Precisely. It's about ensuring tax fairness and preventing income shifting. So while it's not an immediate benefit like a deduction, understanding this prevents you from having an unexpected, large tax liability allocated to you later when that specific property is sold. It ensures the tax burden matches the economic reality of who brought the appreciation into the partnership.
Makes sense.
Okay.
Okay, let's shift to S corporations and basis. For S corp shareholders, you mentioned Box I, loans from shareholders. How do these personal loans impact tax benefits?
For S-Corp shareholders, this is a critical point and different from partnerships. As we noted, general S-Corporation debt, like a bank loan to the corporation, typically does not increase a shareholder's basis. However, a direct loan from the shareholder to the corporation does increase your basis. That amount is tracked, at least at year-end, in Box 1.
And why is increasing basis important again?
Primarily for deducting losses. If the S-Corp incurs losses that flow through to you on the K-1, you can only deduct those losses up to the amount of your basis. Your basis consists of your stock basis, what you paid for stock, plus accumulated income minus loss distributions, plus your debt basis from these direct loans.
So if the S-Corp has losses, and my stock basis is zero, but I loaned the company $50,000.
You could potentially deduct up to $50,000 of those losses against your other income, thanks to the basis created by your loan. Without that loan basis, the losses would be suspended.
So making direct loans is a common strategy to allow S-Corp losses to be deducted.
It's a very common and effective strategy to create or restore basis, specifically for the purpose of deducting flow-through losses in the current period, often the go-to solution when an S-Corp is generating losses shareholders want to utilize.
Got it. What about Box 16 on the S-Corp K-1, items affecting shareholder basis?
Box 16 is also truly critical. It's a summary line that encapsulates various items flowing through from the S-Corp that adjust your stock basis both up and down.
Like what kinds of items?
For example, tax-exempt income earned by the S-Corporation, just like in a partnership while not taxed currently, significantly increases your stock basis.
That's good because...
Because, again, a higher basis allows you to receive more tax-free distributions from the S-Corporation down the line. If your basis gets too low, distributions can become taxable gains.
So that tax-exempt income provides a hidden future benefit via basis increase.
Exactly. It's a subtle but powerful benefit. Conversely, Box 16 also reflects things that decrease your basis, like non-deductible expenses incurred by the S-Corp, say 50% of meals, penalties, etc.
So this box requires careful attention to make sure my basis is tracked accurately.
Absolutely. It directly influences the taxability of future distributions and your ongoing ability to deduct losses. It's a dynamic number you or your advisor should be monitoring closely year to year.
Okay, we've talked a lot about how losses can be a benefit, a sort of silver lining. But you also mentioned limitations. Boxes 22 and 23 on the 1065 and 18 and 19 on the 1120S seem to point to these. At-risk and passive activity rules. How do these impact the benefits?
These rules are absolutely critical gatekeepers for actually using the losses reported on your K-1. Ignoring them can lead to significant disappointment when you find out your loss deduction isn't allowed currently. Think of them as additional hurdles on your treasure map. You found the loss, but you need to clear these hurdles to actually claim the prize.
Okay, first hurdle, the at-risk rules.
No.
Box 22 on 1065, box 18 on 1120S.
Right. The at-risk rules essentially limit your deductible loss to the amount of money you have personally invested in the activity and are economically liable for.
What counts as being at risk?
Generally, it includes the cash you contributed, the adjusted basis of property you contributed, and importantly, borrowed amounts only if you are personally liable for repayment, recourse debt, or if you've pledged personal property, not involved in the activity, as security for non-recourse debt. Certain qualified non-recourse financing for real estate also counts.
So I can't deduct losses beyond what I truly stand to lose economically.
That's the core idea. It's the IRS's way of saying you can only deduct losses on money you actually have at risk in this venture. If your share of a business loss flowing through is, say, $15,000, but your calculated at-risk amount is only $10,000.
I can only deduct $10,000 this year.
Correct. The remaining $5,000 loss is suspended. It's carried forward until you increase your at-risk amount in a future year, maybe by contributing more capital or if the activity generates income.
Okay, hurdle 1, at risk. What's hurdle 2? Passive activity rules. Box 23 on 1065, box 19 on 1120S.
The passive activity rules are arguably even more common and complex. These rules generally prevent you from deducting losses from passive activities against your non-passive income.
Define passive activity and non-passive income.
Okay. A passive activity is generally a trade or business activity in which you do not materially participate. Think rental activities, which are often automatically passive, with some exceptions for real estate professionals, or a business you invest in but don't actively run day to day. Non-passive income is typically things like wages from your job, guaranteed payments for services, income from a business you do materially participate in, and also portfolio income like interest, dividends, and capital gains.
So the rule says passive losses can't offset my salary or investment income.
Generally, no. Passive losses can usually only be used to offset passive income from other passive activities.
Ouch. That sounds like it could trap a lot of losses for investors.
It can be incredibly frustrating. If you invest in a business, it generates a loss, but you aren't involved enough to meet the material participation tests. That loss gets stuck.
So if I have a $20,000 passive loss from a K-1, but only $5,000 of passive income from another rental property.
That extra $15,000 loss is suspended. It carries forward indefinitely until you either have more passive income in the future or you dispose of your entire interest in that specific passive activity in a taxable transaction.
So these limitations are serious checks on loss deductions.
They are, but the presence of these boxes on your K-1, especially if they have an asterisk saying, "See attached statement for additional information," is your heads up. It means you need to pay close attention.
Can you plan around these rules?
To some extent, yes. Understanding the rules allows for proper planning. For at-risk, you might increase your amount by contributing more capital or restructuring debt if possible. For passive activities, maybe you can increase your involvement to meet one of the IRS's material participation tests, like spending more than 500 hours per year or being the sole participant. It's complex, but knowing the rules is the first step to navigating them strategically, rather than just having losses disallowed unexpectedly.
Wow, okay. We've covered a tremendous amount of ground, looking at specific boxes, income character, deductions, credits, basis, limitations. It's a lot.
It really is. These forms pack a punch.
But let's zoom out a bit. Beyond just filling out the tax return for last year, what about the broader context? How can we use this K-1 information for more comprehensive, proactive tax planning? Throughout the year, maybe. Or for future decisions?
That's a great question, because the K-1 really serves as an absolutely crucial planning document. It shouldn't just be a historical record you look at once a year.
It's a tool for looking forward, too.
Definitely. It's a detailed annual snapshot of your investment's performance and its specific tax profile. Ignoring it until tax season is truly a missed opportunity for strategic planning.
Okay, what's one thing on the K-1 that's important for planning, even if it's not exactly a benefit?
One item that fit that description is alternative minimum tax AMT items. These are found in Box 17 on the Partnership Form 1065 and Box 15 on the S-Corp Form 1120S.
Ah, the AMT, another layer of tax complexity.
Indeed. The AMT is basically a separate parallel tax system. It's designed to ensure that certain higher income taxpayers who might have a lot of deductions or specific types of income under the regular tax rules still pay a minimum amount of tax.
And the K-1 reports items that might trigger this AMT.
Exactly. If you have significant AMT adjustments or preference items reported on your K-1, things like maybe accelerated depreciation differences, certain tax-exempt interest from private activity bonds, incentive stock option adjustments flowing through these could potentially push you into owing AMT.
Which could wipe out some of the regular tax benefits we found.
It could potentially negate or reduce some of the regular tax benefits you've identified elsewhere on your K-1, yes. So this box serves as a crucial warning sign. It's a prompt for careful calculation, ideally with your tax professional, to see if AMT applies to you.
Better know ahead of time than get an unpleasant surprise.
Absolutely. You don't want to find out in April that a great tax benefit you were counting on was effectively erased by the AMT. Planning is key.
You've mentioned it a few times now, but let's stress it again. We see asterisks on the K-1 next to phrases like more than one activity for at-risk purposes, or more than one activity for passive activity purposes, and they always point to an attached statement. Why is it so vital to dig into these see attached statement notes? It feels like the fine print people often skip.
This is perhaps one of the most overlooked yet most critical pieces of practical advice we can give you. Skipping those statements is a huge mistake.
Why? What's in them?
They're often the hidden gems. They contain incredibly detailed information that is absolutely crucial for correctly applying the complex tax rules, especially the at-risk and passive activity limitations we just discussed.
More detail than the main form.
Way more detail. The statement might break down income, losses, and credits by specific business activity if the entity runs multiple lines of business. It might show carryover amounts of suspended losses from prior years. It could explain specific adjustments made to your basis calculation or capital account. It might detail the specific types of other deductions or other income.
So without that detail, I might misapply the rules or miss out on benefits.
Precisely. Without this additional detail, you might miss critical facts needed to accurately calculate and maximize your tax benefits or properly claim things like carryover losses. Think of the K-1 itself as maybe the simplified summary page of your treasure map.
And the attached statements are?
They're the essential, detailed coordinates, the legends, the instructions on how to actually read the map correctly. They tell you how to apply the summarized information to your specific situation.
I can see how overlooking those would be a problem.
Oh, I've seen countless situations where clients overlooked these statements only to realize later, sometimes years later, that they missed out on claiming a significant carryover loss that could have saved them thousands. It's truly like finding money you didn't know you had,
Yeah.
hidden in plain sight in the paperwork you already received.
So the takeaway is never ever ignore those attached statements. Read every page.
Absolutely. Every single page, front and back.
Okay, one more specific box benefit back to partnerships. Box 19 on the 1065 reports distributions. What's the key tax angle here?
Right. Distributions basically cash or property the partnership paid out to you during the year. A key tax benefit here is that these distributions are generally tax-free to you, up to the extent of your tax basis in the partnership before the distribution.
Ah, so basis strikes again. That's the payoff for tracking it.
It really is. You generally only pay tax on distributions if, and to the extent that, the cash distributed exceeds your adjusted basis immediately before the distribution.
And if it exceeds my basis?
Then the excess is typically treated as a taxable gain, usually a capital gain from selling part of your partnership interest.
So understanding my basis is absolutely critical to knowing whether the cash I pull out of the partnership is tax-free or taxable.
Precisely. This is where meticulous basis tracking pays off significantly in cash flow terms. It allows you to potentially withdraw significant amounts of cash from your investment over time without immediately incurring a tax liability, provided you maintain sufficient basis. It's a powerful cash flow management tool inherent in the partnership structure.
Okay, stepping back again. How can listeners proactively use this K-1 deep dive approach throughout the year, not just scrambling at tax time? It seems like this document holds power for forward-looking decisions.
Absolutely. The K-1 is a live document, not just a historical artifact. Here are a few ways to use it proactively. For estimated taxes, this is a big one. You can use prior year K-1s, maybe combined with projections you get from the partnership or S-Corp manager, to estimate your expected flow-through income or loss for the current year.
Why is that helpful?
It allows you to adjust your quarterly estimated tax payments much more accurately. This helps you avoid underpayment penalties and also just better manage your personal cash flow throughout the year, rather than getting hit with a huge tax bill or overpaying significantly.
Makes sense.
What else? For investment decisions. Understanding the tax implications revealed by K-1s from existing investments can absolutely influence your future investment choices.
How so?
For instance, if you're comparing a potential investment structured as a partnership versus one structured as an S-Corp, those differences we discussed and how liabilities affect basis could be a major deciding factor, especially if the business anticipates losses in the early years where basis is crucial.
Or maybe the types of income it's expected to generate capital gains versus ordinary income.
Exactly. Or the potential for tax credits. The K-1 analysis informs your due diligence.
Good point. Any others?
For wealth transfer planning. Basis is also critical when thinking about gifting partnership or S-Corp interests, or when planning for inheritance. A high basis in your interest can mean future tax-free distributions for your heirs, or lower capital gains when they eventually sell. Your K-1 provides the ongoing data to inform these longer-term estate and gift planning strategies.
And maybe even for personal finances, like getting a loan.
Yes, potentially. For loan applications. Sometimes lenders, especially for mortgages or personal loans, will ask for your K-1s to help understand your overall financial picture, particularly your share of business income or losses, which can impact their assessment of your borrowing capacity and ability to repay. Having them organized and understanding them helps that process.
That brings up another point. How should listeners best work with their tax professional now that they're armed with this K-1 knowledge? What should they highlight, or what questions should they be asking their CPA or EA?
That's a fantastic question, because your tax professional is your co-navigator on this treasure hunt, right? They have the expertise, but you have the context.
So how do we make that partnership work best?
First, and this sounds basic, but provide everything. Ensure you give your tax professional all pages of your K-1, including every single one of those attached statements we keep emphasizing. Don't assume they don't need page 7 of 8. They probably do.
Okay, give them the whole package.
Yeah.
What next?
Ask about basis. Specifically ask them to confirm and track your basis calculation each year. Many tax professionals, frankly, don't automatically track shareholder or partner basis year to year unless specifically requested or if it's clearly needed for a loss limitation or distribution calculation. It's often considered the client's responsibility, ultimately. Be proactive.
So should ask for like a basis schedule.
Yes, ask for a basis calculation or a summary sheet each year. Confirm they have your historical data correct.
Good tip. What else?
Question. Unexpected items. If you see large or unusual numbers, maybe a huge Section 179 deduction, significant foreign tax credits popping up, or a big swing in your capital account or share of liabilities from last year, ask your professional for an explanation. Understanding why something is reported the way it is helps you grasp the strategic implication and ensures it's correct.
Don't just accept the numbers blindly.
Right. And discuss limitations. If your K-1 shows you have suspended losses due to the at-risk or passive activity rules, actively discuss strategies with your professional to potentially unlock those losses in future years. Ask, can I increase my at-risk amount somehow? Are there ways I could meet the material participation test for that passive activity? What happens when I sell?
Be proactive about freeing up those trapped losses.
Exactly. It requires planning.
Okay, last question here. Are there any other common misconceptions or errors you see individuals make when it comes to their K-1s that maybe we haven't touched on yet? The pitfalls on the map we should warn people about.
Oh, absolutely. There are definitely a few recurring ones. Beyond just ignoring attached statements, a huge one is assuming cash distributions are always tax-free.
We covered that, but it bears repeating.
It really does. People get cash, they think it's fine. But remember, if your distributions exceed your basis, that cash becomes taxable, often as a capital gain. Basis is key. Another common error is not understanding the passive versus active distinction clearly enough for loss deductions. Many taxpayers mistakenly try to deduct passive losses against their W-2 income or portfolio income, which the IRS will disallow if caught. You need passive income to offset passive losses, generally.
Got it. Passive versus active matters.
Hugely. Also, sometimes people confuse their K-1 capital account balance with their actual tax basis. We touched on this, but BoxL might show capital on a GAAP basis or some other method, which is not necessarily the same as your tax basis used for calculating loss limits and distribution taxability.
So they might think they have more basis than they actually do for tax purposes.
Exactly. Always ensure you or your advisor are tracking your tax basis specifically. That's the number that truly matters for these critical tax calculations. Don't rely solely on the BoxL capital account figure without understanding how it was calculated. Hashtag tag outro bub.
So we've taken what might look like, a really daunting government form, the Schedule K-1, and hopefully transformed it into more of a blueprint. A way to understand your potential tax benefits and savings opportunities from partnerships and S corporations.
Yeah, demystified it a bit, hopefully.
We've highlighted how the character of your income, thinking about qualified dividends, long-term capital gains, those special Section 1231 gains, how that can lead to significantly lower tax rates. Literally putting more money back in your pocket just based on what kind of income it is.
Absolutely. And we've shown how direct deductions, like the powerful Section 179 expensing, and even more powerfully, those tax credits we call tax gold, can directly reduce your tax bill, providing immediate and sometimes substantial savings.
And crucially, we explored how your basis, that cornerstone concept influenced by things like partnership liabilities and S corporation shareholder loans, is really the silent enabler. It's what allows you to deduct losses and receive those coveted tax-free distributions. It underpins so many benefits.
It really is the foundation for maximizing the value of these flow-through structures. Understanding basis is non-negotiable for savvy investors.
This deep dive has aimed to provide you with the essential nuggets of knowledge, the key insights, so you're not just informed, but genuinely empowered when you see that K-1.
Hopefully feeling more confident about it.
You now have a framework, a way of looking at your K-1s, not as complex hurdles to just get through, but as invaluable opportunities to optimize your tax position and enhance your financial well-being.
It really is about recognizing the intricate stories these numbers tell, because those stories, if you read them right, can lead you directly to financial advantage.
Yes. Remember, every line, every box, every attached statement on these forms tells part of that story about your financial position and your potential tax advantages.
Paying close attention to each detail, digging into those statements, asking questions, That's how you can unlock significant value. The knowledge itself is your true treasure here.
So what stands out to you from today's deep dive? Now that you know how to decode these forms, how to look for basis implications, character of income, potential credits, what other common investment documents or financial statements might be hiding surprising tax implications just waiting for you to uncover?
That's a great question to ponder.
How can you apply this K-1 deep dive approach?
Yeah.
This sort of meticulous, curious examination of the details, looking for hidden value to other areas of your financial life. Where else can you find those aha moments and maximize your financial insights? Keep exploring.